Welcome again, everyone, and welcome to another Lunch and Learn in our ongoing Financial Friday series. Saney's is excited to offer these sessions in cooperation with our corporate partner, Equitable Advisors. Equitable has a long-standing presence in New York, and a large portion of Equitable's New York client base is built upon the work they do within the public education system. Through Equitable, Saney's members can receive competitive insurance rates and a full array of retirement services, including a complimentary financial profile for Saney's members, which we urge you to take advantage of because it's a great benefit. Our Equitable presenter today is Greg Ronenberger, Equitable Advisors Regional Vice President. Before we get started, please note that participants are muted during the session, but we will have some Q&A time following the presentation. If you do have a question, just type it in the Q&A panel. We're also recording this session and it'll be available at saneys.org in a few days. With that, I'll turn the presentation over to Greg.
All right, thank you so much, and good afternoon, everyone, and happy Friday, happy Financial Friday to everyone here as we are in the middle of May and wind down toward the end of the school year here. And for some of you, maybe the end of your administrative careers, and maybe you're getting into retirement here. So for those that that pertains to, congratulations, and look forward to helping out any way we can. So today we're going to spend a few minutes talking about taxes in retirement time and looking at what the tax landscape might look like for you and how to really plan around that. So the title of the presentation is, Can I Live a Tax-Free Retirement? And I'm going to spoil the answer right away and say no, that is not the case. You cannot pay no taxes in retirement time, just simply based upon the way that your pension income and Social Security will be structured. However, we can do our best to take some steps maybe to limit what we're looking at from a tax standpoint, put more money in your pocket. So what we're going to cover today is we're going to look at what the income and tax situation is going to look like in retirement for many of you. We're going to talk a little bit about what, and this is a personal opinion, what I feel the future income tax landscape might look like, and then how to prepare for some of that on a go-forward basis. There are some different options out there that we can look at today and tomorrow as far as limiting some of those tax obligations that we'll have. So we'll look at some strategies around there as well. And I do want to just put a disclaimer out there right now. I am not a CPA. I don't even do my own personal income taxes because I don't trust myself not to mess up. Although I did get audited for 2019, and I won. I guess you could say you won. I won the audit in that New York State said I'm okay. I think it's because I gave them 97 pages of documentation, and they didn't really want to look at it, so they just sent me the letter saying, hey, you're all right. But just know that what we share here is going to be simply informational and some suggestions. But if you have a specific personal tax question on how things are impacting your personal tax situation, certainly we could help discuss some ideas individually, but those are things that certainly your tax preparer or CPA would be able to help you with. So we're part of the equation here, but not the end all be all right here. What we'll talk about is in looking at where we're at from an income tax standpoint here, actually there's some good news here. We've done this presentation a few times, and in the past, it's been different in that it was a worse picture than it is today. And one of the big reasons is because of the new tax rates. And we know we've lost some deductions, lost some credits, but the standard deductions going up, almost doubling, really starting in 2020, have really had a big impact on what it's going to look like from a tax standpoint in retirement. And the big thing is when people get to retirement, we tend to lose a lot of our deductions. Our mortgage is close to paid off or maybe already paid off, so we don't have a mortgage obligation and a tax obligation, so we can't write off the mortgage interest. Kids are probably out of the house. We don't have dependents that we could claim as well, so that loses a deduction there. So a lot of the deductions that we have in retirement time are kind of gone. In the past, that was the case, but with the standard deduction going up, it's actually saving us quite a bit in taxes, and we'll look at that in a little bit. Most of what we talk about today is going to be based on that married filing jointly number. So that's the scenario we're going to go through, but certainly we could go through individual scenarios at any point in time. And any questions, as was mentioned, you could put them in the Q&A box. Right now during the presentation, I can't see them, but we'll go through and we'll address them later on. From an income tax rate standpoint, this is something that sometimes is misunderstood and gets folks a little bit confused in that many people say, well, I'm in the X tax bracket. So they'll look at that 22% tax bracket and say, well, I'm in the 22% tax bracket. So the assumption is they're paying 22% in income tax on all of their income. But that's not quite how it works. The US tax system, it's a tiered system, or there are marginal tax rates. So you could see here that someone earning over $81,000 in taxable income is going to not pay 22% on all of their income tax. Their actual effective tax rate is quite a bit lower than that. And that is very important as we look at some of the different strategies in how to plan for income sources now and into retirement. So what it looks like, and this graph is based on 2020 tax rates. I couldn't find one of these for 2021, but you could see that when you look at the different income sources coming in, this is for a family of four with $110,000 of income, as you could see. That first 24.8, now 25.1 of income is not, it's taken right off the top. So almost 25% of our income is taken right off the top, not taxed. Then the next bucket of now it's 19.9 is taxed at 10% and so on and so forth. So when you go over to the actual tax rate, this family of four is paying an effective tax rate of about 6%, not 22. Certainly, only a small portion of the income is taxed at 22%. However, any additional income over that number after you get out of the 12% bracket is taxed at 22%. That's something that we want to certainly take a look at here. So in looking at retirement, I'm going to utilize the draw feature here. Many times what we see when we're doing, or when some folks are doing some calculations as far as their tax calculations go, is they're using some basic numbers here and saying, all right, if I have $100,000 income desire in retirement time, we do a quick pension calculation. Okay, that's $60,000 from the pension, looking at our max option there. We'll talk about that in a second. We get a Social Security estimate and we say, okay, that's $36,000 there. So you add them up, there's $96K. I'm only $4,000 short, so I'll take $4,000 out of my 403B, and then I'll be all set for my retirement income. I'll get $100,000 in retirement. Well, that's not quite what's going to happen here. So what are you really going to get in retirement? Well, the first thing when we look at your pension is, and you see I used the number of $54,000 there. So many times people look at their pension, and hopefully many of you have attended some of the pension maximization classes that we've done. And I know we've been hammering on all of you for close to a decade now on taking steps to maximize your New York State pension. Some people do it, many people do not, but there are still some people that take that reduction for the survivor benefit. So it's something that they do in retirement time, but they don't necessarily plan for maybe when they're calculating their retirement income. So we're going to take 10% off for a survivor benefit and say, okay, our net pension is going to be $54,000 per year. From a tax standpoint, well, what do we owe in taxes on that? The New York State pension is not New York State taxed, but it is federally taxed. So know that you're going to pay federal tax, income tax on your New York State pension. When we take off that 25.1 standard deduction, it leaves us with taxable income of just under $29,000. So putting it onto the grid there that we saw before, it's about $3,000 in federal tax. So on our quote unquote $60,000 pension that we were counting on, we're actually going to take home about $51,000 of that. All right, so a little bit less than we thought. When we get to Social Security, again, Social Security is not taxed at a New York State level, but it's taxed at the federal level. And it depends upon income sources, and then something called a provisional income, where they calculate this provisional income number. and it's just a formula that the IRS came up with. How it's determined is not relevant right now, but what's important is that because all of you, if you do a full career in the state system and you have a decent sized New York State pension, you will fall into the provisional income range where Social Security will be taxable. And many people hear this number of 85% and they say, well, if I have to pay 85% tax on my Social Security, I'm not going to take it. And no, we're not paying 85% of our Social Security. 85% of the Social Security is factored into the tax calculation. And that, again, will go against our 12, 22% federal tax rates, whatever the number is. So based on this situation here, the tax on that is just over 10% or so. So our net between the two, pension and Social Security, clocks in at $83,000 per year. Still not bad, but now we're short 16,000 and change of that $100,000 goal, which is much different than the $4,000 number we looked at last time. So if we scroll down a little bit right here, roughly speaking, if we're still in, and based on these numbers, again, with the standard deduction being so much higher and the tax rates being what they are, we still fall in this 12% income tax bracket. Plus, if we probably might have to pay 5% of our 403B distributions to New York State. There are some ins and outs to that, but let's just utilize the example and figure we might have to pay, or we will have to pay in this example, 5% to New York State. So it's approximately $20,000 that has to be taken out of the 403B in order for us to hit that number. So back before a couple of years ago, this number here, as far as what it actually took to generate $100,000, was around 128 grand or so. Now it's 110, which isn't quite as bad. We're not paying as much income tax as we might have a few years ago. However, one of the big concerns here is that in the past, when we looked at this and when we were planning for our distributions to say, well, what is the additional income that we need from the 403B? So let's say this is my 403B plan. And if I'm counting on, as in this example here, if I'm saying, well, I only need $4,000 per year from that plan, but distribution percentage of 4% per year is a very safe number to take from our retirement plans and have them essentially last as long as we do. No one wants to have their plan run out of money before they run out of life, I guess. So in order to do that, to generate that $4,000 per year, we would need $100,000 in our 403B plan. So people are looking at their plans and saying, all right, let me get to $100,000. So if I'm into retirement and I've got 65, 70 or so, and we get a retirement incentive of 30 or so from our sick pay, vacation days, whatever it is, I get to 100, I take that 4%, then I'm good to go. However, if we factor in the taxes and if we believe that, okay, this is the actual number that we're going to be short, so we need to distribute $20,000 from our plan, well, you could do the math. If I have $100,000 in my 403B and I have to take out 20K per year, well, I've got 5 to 6 years worth of income distribution from that plan before it runs out. So what does that mean? That means, well, do I have to live on less in retirement? Do I have to sacrifice some things in order to not have that high of an obligation from a tax standpoint and have this money last a little bit longer? So we could do that, or we could save a whole lot more money in order to boost this up to $300,000, $400,000. Seems like a lot, but that's really what it would take in order to generate that income distribution. So that's one part of it right there. But what should we do right now? What can we do to mitigate the tax impact? What can we do to plan more effectively for this? So right here, you look at the future. I'll go back here to make it a little bit bigger here. When we look at tax rates now and in the past, and we look at where we're at right here, we could see that historically, we're in a very low tax rate environment. And to some people, they say, no, that I mean, that's crazy because we all pay a lot in taxes and we all hate it. But look what happened in the past. I mean, then this is the top marginal rate. So the top marginal rates were much higher. They haven't been this low since, as you could see, the early to mid 20s. And I mean, all this did is lead to a little something called the Great Depression there. But we're in a pretty low historical tax environment right now. And this is important, of course, as we look to what the tax landscape might be going forward. So, and I don't know, I don't have a crystal ball. I wish I did, but I could make some assumptions here. And if this line here represents, to me, government spending. So the government is spending a lot of money right now in different stimulus packages and bills and things of that nature. And it's not my position to say that's right or wrong and different. It doesn't really matter right now. What matters is that the government's spending all this money. Well, it's not a free lunch. This money has to be paid back at some point in time. Where does the government raise money? By taxes. That's how the government raises funds. And if we think the tax landscape is just going to do this in the future, I don't foresee that happening. I could see tax rates having to go up in some fashion. Now, we see the new proposal that's on the table right now, where it's, well, we want to do this. We want to do this on people earning 400K or more per year, and on corporations. It's the getting a lot of buzz now. It's, well, we just want these people to pay their fair share, we call it. Well, is that right, wrong, and different? Again, it doesn't matter, but it's kind of tough to do that. But maybe they tax in other areas. I don't really know what the answer is. I just know that something has to happen and tax rates may have to go up in the future. Now, I could be right, I could be wrong, I don't know. So how do you hedge, really? Well, if we look at the fact that, again, if we're in this position right here, and if we say, well, most of my income is being taxed at a 12% rate, and a little bit is being taxed at 22%. For right now, if we feel like our income, well, if we say the tax rates are low right now, but we think in the future they're going to stay low or go lower, that's one assumption. And from an income standpoint, you say, well, my income is high right now and it will be lower in the future. If I believe both these things to be true, then what I want to do is I want to do more pre-tax savings today. So I want to save on the tax here when I'm earning a higher income. And if my taxes are lower and I'll have lower income, then I'll pay less taxes in retirement time. So we're okay doing pre-tax investing right now, your traditional 403b plans that you know well right now. Now, if I'm on the other mind and say, well, right now, I feel, yeah, taxes are low, but I think they might be higher in the future. And if I think from an income standpoint, well, right now, maybe, I'm high, but I might be the same or even higher. I had someone stop in yesterday. She retired 10 years ago, but it was one of those never really retired, side business and all that. And she's making a lot more now than she did when she was, quote unquote, working. But if we think this is the case, then after tax savings is a good way to go. You may have heard of some Roth savings. We'll get into this a little bit more in a minute here. But paying the tax today or tax-free in retirement then would be a good solution there for that individual who believes that. So all this to say that to have a hedge, if we're not sure, if you say, well, I could see this scenario happening. I could maybe see this scenario happening. I don't really know. So how do we hedge between the two? Well, we have both pre-tax and after-tax buckets to pull from in retirement time. So what it would do for us here is it would say, and let me skip a little bit. Well, let me talk about the different types of plans we're talking about here. So you might be thinking, well, all right, what do I have and what are these things look like here? So if we look at, these are what we call the 4 boxes of taxes. The first box here, it's after-tax money that you put in. It's fully taxable. Really, this is your short-term money, your bank accounts, your money markets, things that you just have saving on the side. They're not really long-term investments. They're short-term. You've got liquidity there, but really no tax favorability in this bucket here. Where you're going to see most of your opportunities isn't necessarily even in bucket number 2, it's 3 and 4. We see most of our savings and retirement income is in this bucket number 3. It's the pre-tax money going in. It's not taxable as it's growing, but it's taxable when it comes out. So 403B plans are here. The traditional 403B plans, pension plans are in here as well. IRAs, spouses, 401ks, things of that nature. They all fall under this bucket. And this is the preponderance of people's retirement income is in bucket number 3. What we say here is let's take a look at some bucket number 4. And what's in bucket number 4? You've got, we say some municipal bonds are in there, your Roth accounts that you've heard of before. And there are Roth 403Bs as well that we could look to take advantage of. Not every district has them, but there's something that could easily be implemented as well. And looking at some life insurance, some cash value life insurance, as we've talked about pension maximization planning and the way to do that with a cash value life insurance policy, we could utilize that cash value from a distribution standpoint as well to give you some non-taxable income in retirement too. So the goal really is to look at from a distribution standpoint and say, all right, if we are, let's say we're 55, 57, whenever it is that we retire and we're pulling in a set amount of income, if we need to take on additional income sources, eventually at 62 to 65, Social Security is going to get added on, and that's going to give us a bump. But as we need incremental income, where are we pulling it from? How are we doing that? Well, think about it this way. To really hedge the taxes as best we can, as we've talked about, the majority of our income, hopefully, is taxed 10%, 12%. A little bit at 10%, so there should be a line there, but a lot of it at 12%. So if we look at our pension, Social Security, coming out right now, and then anything above as we creep up. Now, if we have double pensions as well, that's something that is going to just push our income up until this 22, maybe even 24% bracket at that point in time. So as we need more income, if we could take all of our taxable income, let me change the color there so it's a little bit easier to see. If we take our taxable income in these brackets, and then as we need more money, then we shift to tax-free buckets up here, so we're avoiding paying these extra taxes in retirement. That's the ideal game plan. Pay a low tax rate on the taxable investments, and then don't pay taxes in the higher rates for later on. So how do we do that? Well, if we shift to, so this would be the retirement income, but if we shift to the now income today, and again, the same deal applies. We got the 10%, 12% rate here, and then 22, 24, whatever it is. So of our income, one strategy could be on the money that we're earning over this income tax bracket. So it's 80K, give or take, for a couple that are filing jointly. Use pre-tax investments on this income, because we are, even though our effective tax rate, as we know, is not 22%, we are paying 22% in tax on anything we make over this threshold. So let's say we're making, let's just say, for example, we have $95,000 in taxable income. All right, this is after our standard deduction. So take 15K, put that into our pre-tax 403B plan, and then if we want to save, say, an extra $10,000, well, that extra $10,000 is only being taxed at 12%. So pay the 12% in tax today, put that into a Roth plan so that we're paying 12% tax today on it, but then we're able to take it out here and we're able to avoid paying 22% tax on it down the road. Hopefully that's clear. It gets a little bit busy when I draw all these lines and all this chicken scratch here, but what we want to do is, as we said, just have a plan, have a hedge so that we're utilizing different buckets here. Some of it has to be taxable, as we know, because we just can't avoid paying the tax on the pension, on the Social Security, but then at least into the future, give us some different buckets, some different ways to hedge those taxes so that we could draw from different types of accounts and just have a little bit more of a strategy now in planning for it and going forward. So that is a quick overview of that here. It's, believe it or not, it's already 12:26 on my clock here. So I'm going to put this up for just a minute. If you have questions and need to get a hold of somebody here, these are the folks that help in your different regions. If you want to just jot down a name and a phone number or an email address to reach out to someone in your region to help out, we're certainly happy to do so. And in a second there, I'll stop the screen share. I'll see if there's any questions in the Q&A session. So trying to end at 12:30, just so that you folks had planned for half an hour. That's what the invitation was for, so you could get on to your day. I will stick around and answer any questions that are in the chat here. So I'm going to just flip over here, and I see a couple in here. So I'll just take a look. And what we've got here, two questions. Number one, well, I guess they're both the same one. Was this is going back to, it looks like the income calculation. The question is, was the survivor benefit subtraction based on either taking the full 60 and buying life insurance, or 60K as the full benefit, or we decide to take the survivor option? So essentially, I guess on the one hand, if you are trying to maximize your pension, what I did is I took that and said, well, I looked at the taxable income coming in, so going from 60,000 down to 54 and taking the actual survivor benefit through the state, because in that example, you're only going to get 54,000 in taxable income, not 60. So if you take the survivor option through the state, you're collecting less income, collecting less taxable income. If you take the full pension option and buy life insurance policy on the side, you're still taking in a full $60,000 of taxable income. So your actual amount of taxes that you're paying would be a little bit higher. So that assumption was utilizing the survivor benefit through the state, not by taking a life only option. So it's not, what I was looking at is taxable income, not necessarily spendable income, if that's clear. Hopefully that was there, that I explained that clearly. Question just popped in. What is the best way to grow our investments tax-free if we are not eligible for a Roth IRA? Great question right there. There are a couple of options if you're not eligible for a Roth IRA. Roth 403Bs are a thing. You can do a Roth 403B option through your district. Your district has to have the option to do it. And if they don't, get in touch with us. We'll talk to the business office. We'll try and get that approved for you. It's an option that's very easy for the district to set up, benefits everyone. But because they weren't offered until, I say fairly recently, half a dozen or so years ago, not every district has it because people haven't asked for it, but some districts have it. So the Roth 403B allows you to save on a after-tax basis with tax-free income coming from your 403B. Now, it gets a little technical in that the rules still apply. The 403B rules apply for those funds, not the Roth IRA rules. There's some technicalities to it, but the bottom line is it would give every single person on this call an ability to fund into a Roth 403B at a much higher amount of funds I could put in. So what we like to do, as we talked about on one of those previous slides there, is you could do both. You could do some pre-tax and some after-tax in your 403B to hedge your tax for now and for the future as well. And those are things that our planning process could help you go through. So those were the only questions right now that are in here. This was designed to just give you a couple of thoughts, ideas, quick and to the point. I'll stick around. It's right at 12:30 right now. I will. Oh, there's some things in the chat too. So let me catch those. First one: if someone is alone and filing as an individual taxpayer, why can't they claim themselves as head of household and get the greater deduction? That's a great question. I actually don't know the answer to that because, as I said, I'm not a tax expert here. But I think maybe they can. I'll be honest. I don't know what the qualifications are to claim as a head of household. I don't know if you have to have dependents or what the case is, but that's a little outside the scope of my knowledge base. I apologize for that. Question is, can you contribute to a Roth only at a certain age? No, you can contribute to a Roth. If we're talking about a Roth IRA plan, you could contribute to a Roth IRA plan as long as you have earned income. However, there are income phase outs. So if you are a single taxpayer or even a joint, and a lot of times folks on the call also have a spouse that is working the school systems, you got a double income, you could be phased out of a Roth contribution, as in the previous question before. If we're not eligible for a Roth IRA, you just have to have earned income to contribute to a Roth. But if you're phased out of that, you could do the Roth 403B. But again, you have to have income through an employer to contribute to that Roth 403B plan. So very few restrictions on from an age standpoint. A lot of folks like to have their children set up Roth IRAs. If your 18, 19, 20-year-old child has a job, they earn a few $1,000s, have them put some money into a Roth IRA plan, because they could put that money into that plan, save it, and accumulate money for 30, 40 years and have all that money come out income tax free. You could be sitting on a $500,000, $600,000, $700,000 account, all income tax free come retirement time. That's a really, really nice benefit. That is all I see. Oh, just got one more coming in. How about moving to a backdoor Roth IRA if you exceed the earning threshold? Could do that. That's certainly an option for folks. So what we're talking about is it gets a little technical, but you do a non-deductible IRA contribution, then you convert it to a Roth IRA. There were some income limitations on Roth conversions back a couple years ago. I believe those are gone now. So that is an option too, to do that backdoor Roth IRA opportunity. Definitely something that is on the table for folks to do. So obviously there's a lot of different strategies involved, but really what we want to do is really see, because there isn't a one size fits all when it comes to this. Some of it is personal belief and preference. Some of it is what we're eligible for come retirement time, or now what types of plans we're eligible for, how we like to save. So everyone's situation is going to be a little bit unique and different. So that's really what you want to help take away from this. Question just came in. When comparing the maximum New York State pension versus survivor option, would it be safe to say that two pensions, this is a dual pension couple, should consider the New York State survivor pension since it has better tax implications for a family? Well, there's certainly a tax consideration when looking at it. So I'm guessing what you're asking here is, well, if we pay the survivor option through the state, then we are getting a lower taxable income, so it's better taxed today. Well, that kind of unravels a lot of different things. Number one is that, well, perhaps, yes, your taxable income is a little bit lower when you're both living. Know that on the survivor option, so I'll take myself, and let's say my wife, we're married, I have a state pension. If I pass away today and I'm in retirement and she collects my survivor option, that is taxable income to her. Versus if I have a life insurance policy, that life insurance policy pays out income tax free to my beneficiaries. So in the future, it could be, well, I might save a little bit in tax money when we're both living, but I'm passing on a taxable income stream in retirement for the rest of her life versus a tax-free benefit. So I could look back and say, well, it's actually not more tax efficient. It's less tax efficient that way. But also just have to look at the income need in retirement. Many times double income households, there's only a very small amount of income that the surviving spouse needs to add on if one of those pensioners were to pass away. So many times we're saying, well, maybe the surviving spouse only needs about an extra 10 grand a year. Why take a 75% reduction or leave that type of benefit and pay 5-6 grand a year when we only need to replace a $10,000 income benefit? I could buy a small amount of life insurance, or I could save some extra money into any type of other retirement plan and have enough cash, have enough investments on the side to provide that extra. Social Security plays a part as well, because the surviving spouse will get a step up to the higher wage earners Social Security. So there are a lot of moving parts to that question there, and that's more of a digging into someone's exact numbers situation and seeing what might be better for someone. What's your opinion about 457B? They're similar to a 403B. With a 457 plan, it's a kind of a sister plan, a paired plan. You're welcome for that. So it's the paired plan for people that want to. Here's where 403Bs help, or 457s help. I'm sorry. If somebody wants to double defer, you can actually double defer into a 403B and a 457 plan. So if you're maximizing your 403B and you want to do some additional savings, you could do additional savings in a 457 and essentially double max out a plan if you have the capabilities to do that. There are some restrictions on them as far as they don't accept employer money. It's all employee money. So as you get closer to retirement, you just have to hedge. If you get a retirement incentive, what you're doing there. 457s are nice because if you don't feel like you're going to be in the state retirement system a long time, if you feel like you're only going to be in it for, say, 10 years or so and then go someplace else when you're in your 40s, 457s can be, you could take distributions when you separate from service, whereas a 403B, you got to wait a little bit longer. So they're helpful in that regard. We don't see a lot of that happening, to be honest with you. But where we use them is as an add-on plan, because most 457 plans, it's very difficult to set one up through an advisor. It's easy to set one up in a do-it-yourself format if your district has one. So a lot of times districts set up the do-it-yourself option. You got to figure it out on your own. They have enrollers that you might be able to meet with, but most times they're not really advisors. They help you get enrolled in the plan. And many people just don't want to just self-manage the funds. So there are some good options. There are definitely some benefits to it. I'm certainly not against them. They do definitely have some value in a planning situation. But some people ask me, what's better, 403B or 457 plan? And I always say it depends. Depends on what you're trying to accomplish. I know that's like the standard financial advisor response, right? Is like, well, you always say it depends on your situation, because it does. There's no one size fits all to it here, but they definitely have merit on the 457 side. But again, not all school districts have a 457 plan. If you're looking at perhaps having your district get a 457 set up, we could help them go through the mechanics of how to do it. And the past 4 times I said that's all I see, a question popped up right as I said that, but I haven't seen anything pop up here in a couple of minutes. So maybe we're at the end here. 12:39 right now.
It looks like
that's it.
That's it. And thanks very much, Greg. And as I mentioned before, we'll be posting the recording of this presentation at saneast.org in a day or two. And thanks everyone for coming, and have a great weekend.
Thank you. We'll see you next month.